Step back and see the macro and digest it down to the micro. Trading, investing, and geopolitics from macro down to the micro. Welcome to Macronomics.
Welcome back to Macronomics, guys. This morning, piecing it together, guys. Piecing it together. And today, just simply want to talk about building in your investments, and also the difference between trading and investing. So with that, let's go ahead and dive in. Let me get in my seat real quick. Okay, so building in your investments, guys, and trading. So we recently decided to create a list of instruments to create a macro overview, and I believe we touched basis on this a couple weeks ago. Essentially, creating a database of instruments that we can simply pick through, not even pick through, but just look over and be able to see what's happening throughout these different sectors in the world. Like oil, we have oil, certain indices, bonds, and of course we'll continue to improve on this and expand. So what we currently did, remember the trade we talked about where we made 30% and we decided to get out of the trade? So that was within the equities market, right? Usually a lot of the trades that we talk about is usually within the Forex market, which is currencies for anyone who's not familiar with them. We're usually trading currencies. We like the currencies just because you can trade both ways and without being too much of a hassle. Excuse me. I don't know why all this is coming out now. Maybe because I've been on the computer for just now. Just got to doing some trades and a little bit of chess. But okay, back to the point. So, yes, right now we're currently within the equities in the Forex market. We're not in the bonds or private equity or nothing like that yet. So that's primarily what we're talking about. And so recently we placed that trade within the equities market. We was able to make 30%. We decided to close the trade. And it just taught us a lot, that it was taking a lot of mind capital in order to manage this trade. The reason being, we was dollar cost averaging within this trade, and it averaged probably about a good 50 cents, a good 50-cent margin. We was just scooping up stocks, and the reason being is because you could just tell when something's now you can tell when it's bottom, but watching the market, watching some of the macro events, putting all that together, create a confluence of events, and we just seen that the days it was the percentage moves down was really low, and so we decided to get in. Long story short, we got in, and it was it jumped, and like I think it was a day or two, it jumped like over 50%, and we decided to of what our investment was. We decided to just take the profits off the table, and we said, wow, this is actually pretty draining because we didn't identify our parameters before we got into the trade, right? And another thing is we was looking at it as an investment, right? But when do you get out of your investment? I was listening to something yesterday. If you're invested in something and it goes up 80%, right? But you said you was gonna hold it for 10 years, but based on the macro, based on policy, just all these things that you're able to piece together, you can see that it's coming right back down. Do you take the money off the table? And I think this is where the agility comes into play, guys. Like the way things have done before, I'm not saying it shouldn't be done like that, but you have to be able to adjust and think for yourself and what are your parameters. And for me, if I was investing in 10 years, cool, then maybe I wouldn't be worried about the short-term swing. But if you're in there to make money on it and it jumps 80%, I think, personally, I would take it and adjust accordingly, whatever those parameters are. But back to the trade specifically, so we just noticed that it jumped 30%, and it took a lot of mind, like, do we get out now, whatever? And so long story short, we got out. It ended up jumping probably about another 30%, and now it's fell back down. It erased all of its gains. So we don't know what was going on with this trade primarily. We don't know if it was insider trading, if it was a pump and dump, whatever it was, but simply it was a huge percentage. And we simply got in, we got out. And it hit us like, okay, there's a difference between investing and long-term trading, so to speak. I guess you could say swing trading. So the primary method that we employ within Forex and the equities markets that we're in, our two accounts, is primarily swing trading. But the strategies are slightly different because within the equities market, it's a lot more macro driven. So the trades that we're placing primarily based on the macro sphere and what's going on, and then we dollar cost average into these stocks. Whereas in the foreign exchange, we're not dollar cost averaging. We're simply identifying the parameters that we want to get in and get out at, and of course lining up the macro with the micro. Now, as you guys move forward, I think something that we could extrapolate from today's insights as well as our experience is simply know the difference between the trades and the investments that you're making. What I'm going to do moving forward is I'm actually going to have a different account for investing and, of course, create the parameters around these trades. Investments. Whereas within the equities markets, the trades that were placed, and these are more long-term based. They could be a couple months, they could be a month, they could be a couple weeks. But setting the parameters and following them. So within the equities market, we are looking to trade companies that we have a fundamental analysis of and a good understanding of. We feel comfortable. Overall, we feel like this is a strong company, but we're not investing in it long term. We simply want strong fundamentals, something that we can trade essentially because we understand. Like a good example would be Google, right? Google, I believe right now it's at 115. It's down. And I see a confluence of events across the whole equities market. If you look, it's the same pattern. It's a gap down. And across all the instruments that I've been analyzing, there's a gap down. So this is what I mean within the equities markets, in that you have to, like, the market moves as a whole, and you have to identify that. And yes, there might be micro changes within these, small, not smaller, but these different stocks. But you want to be able to move with the market. So that's why primarily that's one of our big strategies within the equities market, is understanding how the market's moving as a whole, because most of the market does move as a whole, and something within a different industry within the stock market can affect other industries. So keeping that in mind. And so to conclude and solidify today's insight, we are going to just identify these parameters upon which we trade and invest. So investing is not the same as trading for us, and we're gonna trade, or not trade, but we're gonna create another account so that we can invest, and it's not taking up a lot of mental capital. And when we invest, of course, we're gonna have parameters around those investments. What are we looking for? What are we looking to get? Like, if you want to see if what this stock can do, and it jumps 200%, and it's only been a year when you said you're going to get in for 10 years, you have to be able to sit back and analyze and understand if you should take that off the table. It's just a lot that goes into it, guys. It's not just simply putting it into this, putting money in the stock and waiting 10 years. Personally, in my view, because you can get to that 10-year mark and there can be a huge downdrift. It's just so many parameters, and I feel like being able to step back and watch those investments and analyze and piece the moving pieces together is important, especially as we move forward. And so that's the investment side. And then within the equities markets and within our account that we're trading on, that understanding that those aren't investments and setting the parameters beforehand. Are we looking for a 15 to 20% move? Cool. These are the parameters. We're going to dollar cost average down to this point. If it passes this threshold, then we'll dollar cost average out, etc., etc. So it's just, it's piecing it together. That's a little bit of our approach and how we are approaching the markets. And it's changing, guys. We are adapting through our experience. That's a big one too, guys. Learning from your experience. Yes, learn from people. Learn from, what we're sharing. Learn from books and whatnot. But at the end of the day, you got to put it into action. And guess what? You're gonna see some that's not someone else sees, and it might work for you. It might not. There are thousands of different strategies that people employ across the world to make money within the markets, and they're all different. And guess what? They're all right. No, there is no one way to skin a cat, so to speak. There's 1,000 different ways to do that. I'm sorry if that's a little graphic. Maybe it's 1,000 different ways to trade the markets, guys. So the biggest thing is learn from your experience. Get out there. Get out there and learn. If you're risk averse, lower your risk. If your risk tolerance is low, lower your risk. Maybe put down a little bit and see how the markets move. Analyze them. Today I haven't traded I haven't placed any trades at all within the forex market or the equities market because I don't see anything. There's a part of me that looks forward to it, and yes, I would be not remiss, but lying if I didn't say that I was looking forward to trading and place some trades, but I don't see it. There's not a confluence of events on the macro and the micro. Yes, I see some micro, and when I say micro, we're talking about the technical. I see a lot of technicals, within the forex market specifically, but it's not lining up for me. Last week we had a pretty good week. Closed the week with some good profit. It's just being okay with it, guys. And the biggest thing that to solidify today's message is simply this: learn from your experience. Get out there, journal, learn what's working, identify certain leaks, plug them, see how it's working, and then from there learn. And of course, coordinate with other people's experience, but do not let those experience be yours. Okay? So that's it for today. Continue to put the macro and the micro together to create what it is that you want to create.